Your tax bill for 2026 could be thousands of dollars higher than you expect, not because of new taxes, but because valuable tax breaks you've been using are about to disappear. If you're planning to install solar panels, claim certain deductions, or have a larger family, you need to hear this today. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Today, we're talking about three major tax benefits ending in 2026 and what that means for your household budget. First up, clean energy tax credits. If you've been thinking about installing solar panels or buying an electric vehicle, your window is closing fast. The federal EV tax credit already closed. $7,500 ended September 25th. The residential clean energy credit, that one, energy and efficient home improvements credit, both end December 31st, 2025. Here's what this looks like in real numbers. According to Treasury Department data, 1.2 million households have saved about $6 billion using these credits. That's an average of $5,000 per family. So if you install the same solar system in January 2026 that your neighbor installed in December 2025, they saved $5,000 on their taxes and you saved nothing. Now, there is one exception worth noting. The federal tax credit for at-home EV charger equipment doesn't expire until June 30th, 2026. That's still worth up to $1,000 in savings if you act before the deadline. What does this mean for you? If you've been considering any energy efficient improvements, the time to act is now, not later. Second major change, itemized deductions are getting permanently eliminated. Before 2018, you could deduct things like unreimbursed work expenses, investment expenses, tax preparation fees, and the home office deduction for employees. More than 21 million households use these deductions. The original tax law suspended these deductions temporarily, and they were supposed to come back in 2026. Instead, the recent tax bill ended them permanently. The idea was that the higher standard deduction would offset losing those itemized deductions. But here's the problem with that logic. Whether the trade-off actually works depends entirely on your specific situation. I had a client last month who's preparing for years to claim their home office deduction again in 2026. They work from home, pay for their own supplies, and have significant unreimbursed expenses. They were counting on several $1,000s in tax deductions. Now, gone. Standard deductions doesn't come close to making up the difference for them. This is where strategy beats rate always. And that applies to taxes too. You need a strategy for your entire household financial picture, not just accepting whatever the government says should work for everyone. Remember, one tax code, two tax systems, one for the informed, one for the uninformed. Have you filled out your corporate structure yet? Have you built one? I'm telling you, if you have an LLC, a sub-S corporation, the LLC taxed as sub-S, you might find some benefits there. I'm not giving you tax advice. I'm not giving you legal advice. I'm just saying you need to talk to your financial people. And yes, I know you probably heard this before. A lot of people don't like companies like Amway, but that's a small business. Third change affects families most directly. The personal and dependency exception is ending. Back in 2017, this exemption was worth $4,000 per person in your household. Nearly 292 million people used it, saving about $1.2 trillion total. The government eliminated this exemption and gave families a higher child tax credit instead. For some families, this works out fine. For others, it doesn't. Let me give you an example. Married couple with 5 children who itemized their deductions could actually see their taxable income go up by tens of thousands of dollars under the new system compared to the old one. Even with the higher child tax credit, depending on their specific situation, they might owe more in taxes. But here's what really concerns me. The child tax credit now has stricter eligibility rules. Starting in 2026 tax filing season, qualifying children and at least one parent must have a work-eligible Social Security number. About 2.7 million children who previously qualified may not be eligible next year. So what's the takeaway? If you're a single filer with no children, you're probably going to pay more taxes. If you're a married couple with kids, the math might work in your favor, but only if you still meet the new eligibility requirements. Bottom line, here's what I want you to understand. These tax changes affect your household cash flow. And cash flow is everything when it comes to building wealth. Every dollar that goes to unexpected tax bills is a dollar that's not working for you. This is exactly why we evaluate everything through safety, liquidity, and return. You need liquidity to handle changes like these. You need a strategy for your entire financial picture, looking at how all these pieces fit together. If you're concerned about how these taxes might affect your family's financial strategy, go to rsrlinks.com/keysteps. rsrlinks.com/keysteps. That's where you can get your financial house in order and see where you stand. We'll look at your complete household picture, not just one piece at a time. Remember, strategy beats rate always, and that applies to taxes just as much as it applies to debt management. This is Ron Siegel reminding you that building wealth isn't about chasing individual dream breaks. It's about having a strategy that works no matter what changes come your way. That's the Borrow Smart segment, brought to you by GetHomeSelect.com, GetHomeSelect.com.